Good afternoon, everyone. This is Tim McCusker, Chief Investment Officer of NEPC. Really excited to have everyone back once again, and I'm thrilled to have with us today Rick Rieder. Rick is BlackRock's Chief Investment Officer of Global Fixed Income and also the head of Global Asset Allocation. Rick brings with him a tremendous wealth of knowledge of markets and a global perspective of everything that's going on around the world. So we're really excited to walk through things with Rick today. And before we welcome Rick in, just a quick housekeeping item. We won't have a CIO conversation next week. We thought with Memorial Day that hopefully folks take some extra time and can get away a little bit and enjoy some time with family. We'll skip next Tuesday. We'll come back June 2nd. And we'll have George Walker, the head of Neuberger Berman, to talk about the future of the asset management industry. So, Rick, thanks for joining us today. We're really happy to have you here.
Thanks, Tim. I'm thrilled to do it. Thank you.
Great. So, Rick, before we get into what's going on in markets, I'd love to hear just how you personally and BlackRock as an organization have adjusted to everything that's gone on to working from home. What was that transition like initially, and now 8-10 weeks into it, how are you guys handling it?
Great. Thanks, Stu. So I'd say one thing, if you go back to the end of March, I was thinking about this the other day, that I remember, forget when we were talking about, listen, we're going to be out of the office, and I think it was Larry, our CEO, we're going to be out for the next week. And he said, we're not going to come back for a month. I said, a month? How can we be out for a month? And here we are. And now we're looking at, I'm not sure the date we are going to come back. And it's almost this feeling of what is now a normal abnormal for us, in that, business is running, communications working really well. The technology, every now and then I yell at we use WebEx. Every now and then I yell at it as it's slow in places. But we've been over communicating. And we've been setting up meetings, and we've been getting a lot of young people involved on a regular basis in our calls. And it's been this cathartic experience, in that you realize, and which I think has got a permanence to it, that, gosh, everybody doesn't have to be sitting together in the same office. And so anyway, I've been doing it I'm in Florida, and with my wife, my two girls, and their boyfriends also came down, and I've got all my screens up. I've even been doing some of the TV. They put a background to my in my office, so that I can actually do TV, and it looks like I'm in the office. So I don't know. It feels at this point, it feels normal, and which I think, like I say, I think there's going to be some permanence to not just for our business, but for, I think, a lot of working remotely more.
That's awesome. Now, were you, your team, did you embrace video before this at all, and have you embraced it now? How has that changed things for you guys?
So I have this crazy process when we do our meetings, where we go through our mutual funds, and we literally, there's been some funny stories about this, where we all crowd into my office, and because we like to hear from people in high yield, the secured markets, the rates markets, and so we all come together. And then obviously with Europe on the phone, and over video, and then Asia on the phone and video. But literally, I've always loved the idea that everybody, in fact, I've literally been yelled at for fire hazard reasons for having people. In fact, one day somebody, we're so many people in my office, true story, that somebody passed out. They were fine, but because apparently the oxygen was getting sucked out of the room, which is probably my talking, but anyway, it was always this, gosh, we got to be together, and you have stream of consciousness discussion, and then how it's evolved now to, while using video and for our teams in San Francisco, our teams in London and Asia, but now it's just become very natural in terms of working through video, and quite frankly, calling up presentations or charts on our screens and diagnosing them. Well, it's worked pretty well. I have to say one other thing. It's actually, because we're doing it now more, when you see everybody on the call, as opposed to when you have people you don't know who's on or not on a call. Now I know everybody who's on a call, whether it's a WebEx or what have you, and you can call on different people or ask for input from different people. It's amazingly efficient. So anyway, I think there's going to be a durable permanence to a lot of how we do this going forward.
Yeah, we've talked about that at NEPC, for our management group, which is 9 people, 7 of the 9 of us are in the Boston office. And so we got together in a conference room every 2 weeks, and there'd be 2 folks calling in, and maybe there'd be 1 or 2 more if someone was on the road. But now on video, it's kind of democratized things where the folks that are usually calling in and can't speak up as much, we're all kind of in it together. I think going forward, we'll probably stick to video now.
It's great. Yeah, no, it's great. And you think about the productivity of, travel is important, but if you cut some of that back and you can do some of it where people can do it that way, it's you realize it's increased productivity. It's significant.
Yeah, it's awesome. Well, let's turn to markets. You've got a global perspective across fixed income, across the entire capital stack, really. But let's lay out how you're thinking about the world. We were talking before about these dense presentations that you put together with millions and millions of charts. So let's boil that down and talk about where you see the global economy and markets right now.
Yeah, so it's hard to do, by the way, without my charts. And usually it's like a crutch for me, but they're I think you mentioned it earlier. I'm a bit more enthusiastic about things than I think is consensus. Not everywhere, and I'll talk about some places where I still think are challenged. But the thing that's given us the most comfort, I would say, the first thing, from day one, and whether that's through experts we work with, or I sit on the board of Emory University, and I do a lot of work in the sciences. That one, we're enthusiastic about innovation and in healthcare, and that you will see some more active testing and vaccines. So, I wouldn't say that we've made any investment decisions on that, but I would say generally enthusiastic about where that's going, not just domestically, but in some real innovation in Japan and China, et cetera. But the thing that has gotten me to the place where I think, and we talk about this in the media a bunch, is that the amount of stimulus that's come in is extraordinary. And the difference between this and the global financial crisis is that this is both fiscal and monetary stimulus of extraordinary proportion that's come in. And I think people underestimate how big those numbers are. And we ran what I put in the monthly, the amount of fiscal stimulus that's come in. And what we did is we assumed the unemployment rate would hit 20% in the U.S. or could peak at 20%. And then we ran what is the income loss that comes off the backside of that. And without even factoring in the multiplier effects when you get expenditures and things like healthcare or consumption, et cetera, because the size of the fiscal is so big, it actually works out to an income, even with peaking at that unemployment rate, you get an income level that's about 30% bigger than on a daily basis, daily spend number that's 30% bigger than it was pre-corona. Now, that assumes that the savings rate won't go up, which it will, and more people will save, and it assumes implementation of these programs gets into the system, and there's obviously some blockage around that or some inefficiencies around that. So, but what it did is just show that, gosh, the sheer size of this is so extraordinary that it will create an economic paradigm that is not necessarily V-shaped, but that will create some economic growth of that will take a few quarters. We're not going to see the unemployment rate back to 3.5% where we were for years because there's some permanence to obviously the structural breakage. But if you take that fiscal and you marry it to what the central banks did or are doing, and so Jay Powell on 60 Minutes the other night, I mean, it has been, I think he was A+ in his performance. And, I think the one thing that I know he talks to Bernanke and I've had conversations, and I think one of the things that Chair Bernanke has been public about is that if anything, the financial crisis, they should have been bigger sooner. And I think Powell has just taken it on, and we'll talk maybe later about the sheer size. When you take your balance sheet from 7 trillion to 11 trillion, and maybe I'll just throw some numbers into perspective. When you get the balance sheet to $11 trillion, the entire aggregate index for fixed income is only $23 trillion. Actually, in notional terms, only 21 trillion. So you're talking about taking the balance sheet to over 50% of the whole fixed income market, and which we can talk about has huge ramifications for markets and for fixed income and equities. But that's the sheer size of that, and then targeting that policy at places like investment grade or credit, places like the commercial mortgage area, gave you some comfort that, gosh, our view was people are underestimating how big this is. And so that, and if you take that and you marry to, if you look at the data in China, the data in China is amazingly impressive about how V-shaped that is. I mean, auto sales are now running at faster than they were pre-corona, and oil demand is now above where it was. So I think the rest of the world, I think Europe is going to be much slower, and I think emerging markets are going to be much slower. But I think, places I think Asia, China, US, I think the data is going to be better than people think. And you're starting to see that in some of the high frequency data that's come out in corporate earnings and things like auto parts or, some of the manufacturing data is better. Obviously, some of the retail, the online retailing has been pretty impressive. So anyway, I'm not saying that's not going to be a long slog. I think this virus is going to be with us for a long time, and it'll be a long time before people get on planes or hotel, et cetera. But in terms of the broad aggregate economy, I think people are underestimating the ability for it to come back.
So it's funny. You look back. There's the old adage, "Don't fight the Fed," and I feel like over the last 10 years that evolved to just follow the Fed with the monetary stimulation that happened and the rise in equity prices. Is this a big continuation of that? That look at the places where there's been a lot of support, and those are the places to be. The U.S. being one of them, and maybe China. The government response hasn't been as big, but it's been enough of a V-shaped recovery where they haven't seen it. Can you compare the U.S. to the rest of the world and how that might play out?
Yeah, I mean, I'll finish that one thought that, because I think and then, by the way, I'm just going through these numbers this morning. So I know I'm pretty excited to go through some of this. The numbers are pretty staggering. So if you take what they did, and then we'll talk about, where I think it's harder go. But if you take the fixed income market, the yield on the ag is 147 with a duration of 6 years, and it's a $23 trillion market value, $21 trillion amount outstanding notional size. And so again, the Fed's going to take the bet. It's currently $7 trillion, going to take it, we think, to 11 trillion. The Gov Corp index. So let me go into it. The Treasury index is 56 basis points yield with a 7-year duration, and it's 8 trillion. Again, the Fed's going to go to 11. Gov Corp, which is, as you all know better, which a lot of endowments, pensions, part of the index, is a 1.45 yield with a 7.5-year duration. And that market is 16 trillion market value, 14 trillion notional, 14.7 trillion notional, meaning if you take the Gov Corp or the investable long duration index, 14.7 trillion in size, and the Fed's going to buy 11 trillion. Or take a balance sheet, should say, 11 trillion, 76% of fixed income markets. These are historic numbers. I mean, not historic. I mean, there's nothing been close to this in history. So I think part of why, what the Fed is doing is they're functionally saying, okay, we're going to make the interest rate market, we're going to make the Treasury market unattractive and uninvestable, and you're going to have to find something else to do. And so, you're seeing that play out in markets, but it's part of why it's driven the equity market to where it is. There's not, people can't invest in the 3-year note at 21 basis points. And so I think that is really powerful. But you take that, and then you've got, through innovation, technology, and a better demographic in the U.S., you can see how growth can be catalyzed to come back to where we think next year you're still going to have an unemployment rate that's probably over 7-ish%, but GDP can still run, if you keep the stimulus up, GDP can still run close to 5% or so into next year. But then you take the paradox of that and you look at Europe, where you don't have the investment technology or innovation, and the leverage is already too big, and the demographic is still pernicious. It's pernicious. And then you go to negative rates, which don't work, in my opinion, do not work. And so then you just buy more assets. And I think Europe has a harder slog until they get real fiscal stimulus in the form of things that get at innovation and technology, like China is doing. And so I think you'll see, China is, super impressive about how it's recovering today, including, by the way, people congregating in restaurants and getting on planes. It's pretty amazing. So I think the U.S. won't have that same trajectory, but pretty good. But then Europe, I think, is hard. I think Japan is really hard. And I think emerging markets, are really difficult. They don't have the resources and the rate of development, and they don't have the monetary policy tools with that sort of efficacy to it. So our investment and the way we've oriented our portfolios is be more heavily oriented, particularly with equity, in the places where we think the growth is going to be more significant and more certain in terms of its significance for at least the next few months.
Okay, a lot of directions we could go there. I want to stay on the U.S. for one more minute because I'm fascinated by this one part of it that you described, I think, perfectly. That the Fed is going to push everyone out on the risk curve. They're going to make Treasuries so unattractive. They're going to buy most of it, and they're going to push everyone into credit, out into equities. And the part that I'm struggling with in all of that is the virus side of things. What if the virus and the associated shutdown, whether it's a second wave or something else along those lines, what if the economy doesn't come along? What if they're pushing everyone out on the risk curve, but what if the defaults start? What if the earnings are terrible? How does that start to play out? And the Fed can't help that. What happens then?
So it's hard, and we'll talk a little bit about, part of why I think, before, I think the equity market, I think when the S&P 500 was at 2,200, 2,300, I think you were factoring in a whole lot of downside. With the S&P 500 over 2,900, it is at best in the near term fair value, but I think medium to long term, because of everything that we described, I think the medium to long term, the equity market is actually very fairly valued, in fact, reasonable in a bunch of different ways. That being said, the uncertainty is still high, and the uncertainty of we could have a second wave of the virus is real, and particularly at the rate we accelerate the reopening, it is real. So part of how we're thinking about that in portfolio terms is, there are a bunch of places where we like being up the capital stack, and in many ways, talk a lot about building income in the portfolios in a multitude of ways to be up the cap stack a bit more, and not take as much heavy beta risk in the equities with the market up here, because there, like you said, you can't write off the risk of this reverberation. The only thing I will say is, if we get it, it's about policymakers, and Powell said it on 60 Minutes. We're ready to go in terms of doing more. They're going to do it state and local. I think they're going to go at universities and colleges. They're going to do more, and I think the fiscal apparatus will do more. And we can debate longer term the amount of debt we're going to put on, and how do we deal with that. But I think they're pretty committed to try and deal with it. But listen, I've been in around healthcare and some businesses around healthcare, and we have some investments in things like Gilead and some other companies around that. The innovation is pretty exciting around what's happening, but much of it doesn't actually come into be really powerful for a number of months. So the risk is still out there that you get a reverberation. And by the way, that reverberation doesn't emanate from the U.S. and it comes in another part of the world, which will just keep people more conservative for a period of time. And then the corollary of that is from investment, how we think about investments, taking a lot of risk in mezz or down the stack in things like commercial real estate or different parts of commercial real estate, or some of the stress there is a high yield. I just think it's worth being patient on for a while.
Sure. Let's talk a little more about some of those other parts of the world, particularly emerging markets. You mentioned some of the challenges. Most of the world doesn't have the luxury the U.S. has of having the reserve currency of the world and being able to issue debt to manage through all of this. Can you first generally talk about some of those challenges in EM, and then who are some of the winners and losers that you might expect in EM?
Yeah, so the first thing I will say is, we've been doing in our portfolios is we've been buying what is higher quality emerging markets, and sometimes I feel like that's a bit of an oxymoron, because once you think you're in the higher quality areas, you get some surprise political or otherwise or other announcements. But there are it's getting more difficult to find. Brazil is going through a very, very difficult time in a number of fronts, from fiscal to the health side to organic economic challenges. Argentina, South Africa, Turkey are all pretty challenged today. And so, finding the parts of the world. I mean, Mexico is certainly challenged in some ways, but we feel okay longer term around Mexico, Indonesia. We feel pretty good about. And then finding from a debt side, I'm not a big believer in a lot of assets in Russia, but from the debt side, actually Russia's been is in a pretty good fiscal spot. And then, quite frankly, finding some companies intra some of these regions that are well capitalized in places like India. There's some good companies. There are a couple of really big quality companies in India that we like, and one of which Facebook just put a bunch of money into, Reliance Industries. Mm-hmm. So, but I think you got to be really, really, by the way, with all the markets now, I think you got to be really, really refined around where you go to find the opportunity. And I think EM is tough for a while. And like you said, which I didn't bring up before, the dollar is a big risk to those countries today in terms of their liabilities, and the risk that the dollar appreciates from here is significant.
Sure, they're not going to be able to issue enough to manage through some of this stuff, and then if they're issuing in hard currency, they've got to pay that back dollar for dollar. They don't get the benefit of printing, right? That is a real challenge. So talking about some of the concentration, just coming back to, I guess this brings us back to the US as much as we're trying to skip around the rest of the world. You had some fascinating stuff in your last monthly update, just the size of, you talked about the concentration of treasuries and the size of it relative to the overall aggregate index, but you had some fascinating stuff on individual companies relative to major indices that we see, and the implications of concentration in some of the equity beta exposures. What are you thinking about there, and how can investors attack that going forward?
So I'm doing a little bit from memory, but there is some. I mean, we're living through something nobody in investments have ever experienced. That I should use the example that Amazon's market cap is now bigger than the high yield market. Now, if you want to build balance in a portfolio and you want to create income in a portfolio, that is an extraordinary statistic. And the top 5 companies in the S&P 500 are 300% the size of the next 5. And if you take those top 5 companies, they make up the size, their aggregate market cap. So the Microsofts, the Googles, the Facebooks, Apple, make up the almost the entire size of the investment grade and the high yield market combined. I mean, so building balance is a really, really tricky thing. And I think I showed that the NASDAQ has created 2 Russells this year. So you're seeing this extraordinary dispersion and bifurcation. It just makes you, if you're investing in equities today or trying to build balance in the portfolio, you need these leaders to continue to lead. And as some businesses are going to be harder to come back, and you need to count on the ROE that these businesses are able to throw off. Will continue to drive the equity market from here, and that becomes a bit of a tricky thing overall in the markets. But I'm a big believer that what will continue to win in the markets is, if you go back, I always talk about technology and demographics are the 2 biggest drivers of investing in our world today. And that manifests itself into, what's happening with cloud and semiconductors and things like nanotechnology and artificial intelligence, and in healthcare, in a variety of forms, that I do think those are going to continue to be a bigger and bigger portion of how you invest in, certainly in equities. But, building balance in a portfolio when you have those challenges taking place today is really tricky, and it creates some extreme volatility in the markets. I mean, you think about what's happening. I memean, every day. And my wife says to me, "How did it go today?" And I had to do another fist fight with the markets. It's the vol is just extraordinary. I mean, how do you go up 4% yesterday? Now we're down 1% today, and it doesn't take much to get it moving. And and by the way, on what are yesterday, we could describe a series of things, but certainly the Moderna news around vaccine. People were constructive on Powell, but then you could go down and get another 2%, the next day. The volatility, because you're getting such concentrations, is and it's hard to create balance. And then the other side of it, it's hard to create. We always use a lot of hedges in the portfolio. So you think about what is your hedge in a natural portfolio today. Duration is your hedge. Well, the Fed has made that useless, other than maybe the long bond. But while the long end of the yield curve, at 142 yield, is reasonable and a decent hedge, the Treasury is issuing immense amounts in the back end of the yield curve, including the new 20-year note that's going to be issued tomorrow. So, that becomes tricky. And what are the other hedges? Gold maybe, and we like gold. That's part of the portfolio, but that is certainly not a perfect hedge. And so, and with volatility being as high as it is, to use a lot of the volatility markets like put options or put spreads, that's expensive. So, part of what I think you got to do today in terms of portfolio construction, we're trying to build a lot of income into our portfolios, keep your beta risk reasonably contained, and hold more cash. And it's a different construct than where we were certainly a few months ago.
Yeah, that to me is one of, if not the biggest challenge for diversified investors going forward. And I know a lot of the portfolios that you oversee are meant to construct a diversified portfolio that balance from an asset class perspective is hard to create, because you just can't get, you've got some sort of long-term target return you're trying to hit, and when Treasury is giving you 0.6, it just makes it really hard to build out the rest of the portfolio. And if you're not going to hold those Treasuries, where's the balance? Where's the diversification for all those risky assets? And we're scratching our heads right now, because it's hard to construct complex hedges. Like you said, gold is interesting because of all this debt issuance, but it's volatile in and of itself and can go sideways on you for a long time. I think this is one of the biggest challenges for investors going forward.
Totally. Yeah, and it's just the right part of. Yeah, I think if you run a lower beta and you have to hold more cash. Mm-hmm. But one of the things I've argued is creating income and just keep creating income. And one of the strategies we've been doing more in our equity-oriented funds, but some places where we can hold some equity, is with volatility as high as it is, you can sell, including those names we talked about that are created these concentrations. You can sell call options and functionally just overwrite your exposure. And with volatility so high, you can actually build some income into the portfolio. So part of what we're trying to do is create stability by using income, buy a lot of what I call middle quality fixed income assets. So not stretch in EM like we were talking about, but just the better names, not stretch in high yield. But there's still some names that can get you 4 to 5%, maybe a little bit more than that, and just build that income in the portfolio to create stability and just run a lower beta than you otherwise would, because it's hard to hedge it.
Sure. We talked a little bit about debt issuance. You mentioned it earlier, some of the long-term implications. Let's talk about that a little bit more. The debt issuance is necessary, the liquidity creation by the Fed. It's what the economy needs right now. We think about the long-term implications coming out of the global financial crisis. There haven't been many thus far. The dollar rallied substantially over that time, probably a lot because of what was happening in most of the other countries and currencies around the world. But what do you see for long-term implications today, looking out for rates and for currencies across the world?
So, I think first of all, I think the Fed's going to win, and I think if they want to keep rates down, they can keep rates down, and like Powell said, they have an unlimited toolkit. However, there's something that's going to evolve, and we haven't been a big believer in inflation for a long time. Well, it was a Bloomberg article misquoted me yesterday, but we haven't been a big believer that you're going to get any significant inflation into the system, because the headwinds from technology and demographics are so pernicious that it's really hard. In fact, the central bank's goal of trying to hit 2% inflation, we thought was dubious for a long time. And now you've got real deflationary impacts certainly on goods in around the world, not so much in services, but some. But I think one of the things that's going to happen is, and I'm not sure it's going to emanate from the U.S., but as you put more and more debt on the system and you functionally take your currency or put the influence on your currency and cheapen your currency, I think you create what is an inflationary dynamic that's driven by financial reasons. And I think it'll start from Japan or Europe, because I don't think there's enough nominal GDP to offset the debt that's being put on. And then the demographics make it so challenging, let alone discussions on immigration, et cetera. And I think that's really hard. And I think you ultimately monetize, the debt will get monetized somehow. And I look at places like Italy and think about, which by the way, from an investment point of view today, I actually think is okay, but longer term, the math is just so hard to make work, because you're going to grow debt to GDP to such levels, and what the central banks have to do is they have to create nominal GDP above your cost of debt, but that's really hard. And as you keep putting debt on the balance sheet, and so I think Japan and Europe will ultimately, there's a good chance they'll have to monetize the debt. Part of why I think gold is a good part of the, not 20% of the portfolio, but as a 3 to 5% part of a portfolio, depending on type of portfolio. But I do think that's going to happen, and I don't think you're going to have runaway inflation similar to what you had 70s or earlier periods of time. But I can see a dynamic where inflation starts to move higher into you can create 3 to 5% type of inflation we haven't seen in a really long time, and it can be destabilizing. If interest rates, that's what you're referring to, but when you take CBO estimates in this country and you look at what debt to GDP gets to and whether the country can afford it, the country can afford it as long as interest rates stay down. But if you start to shock interest rates up 100 basis points, 200 basis points, you create a debt to GDP and a real stress on the system that is untenable. And that is a risk. And that I don't think that's a 2020 or probably not 2021, but the longer term effects of this are real. And so, you hope, and I think it's the case in the U.S., that you create enough nominal GDP, you're able to bring the debt down. And like I say, so far, we're in a pretty good place because the consumer households are roughly delevered. The financial system is roughly delevered. And so you can put a bit more government debt on, but, you reach a point where it can be exhausting to the system.
And I think from what you've written so far, that additional government debt isn't being held by outsiders, it's being held by the government because the Fed's buying most of it. The actual picture of external debt stays about the same, right?
Totally. And then, in Japan, they're buying all of it. I mean, they're buying all of it, and they've been buying all of it. And at some point, they're just going to tear it up. And I think, I don't know I don't know how that plays out otherwise. It's just so hard to see that manifest. But like I said, the U.S., I think, has the ability to do it. It's just it's got to be persistent in terms of getting at the size of that debt.
Sure. I'll ask one more question here, and then I should have said this at the outset. I keep forgetting this every week. I got to get better at it. But in everyone's GoToWebinar bar on the side, you've got the ability to throw a question in there, put it in the chat window, and we'll ask Rick. We've got a couple coming in. Rick, what do you see as the biggest risks for investors right now?
So I'd say there are a few. I mean, the one that I've been wigged out about that I have not, never say on TV, but I think, and which I saw play out to some extent, I get very nervous about people selling volatility. And then it's sort of a nuanced thing, but I don't know. But I think people underestimate how big a deal that is, because you get these systematic volatility sellers in the market, and quite frankly, a lot of times when the markets are moving radically, it is that and the machines that are moving these markets. And that, quite frankly, I think people underestimate how destabilizing that could be at times. You saw that in 2018, you saw that period certainly in the last couple of months. But that, from a market practitioner point of view, that is a bigger risk. And I would, that I would certainly talk to policymakers about it. That is something we got to be careful about. The others are that, China, I think, is a really, really big deal, let alone the geopolitical risk between the U.S. and China that's going to accelerate, I assume, into the election. But, they have to keep growing. And, I think China can do it, and I think they will do it. But China always strikes me as the debt's too big. And I think their economy can grow, and I think they'll be able to delever over time. But that one always makes me a bit nervous. And then, like I say, I think the risk to the system, I mean, obviously the virus is front and center, but I think away from that, I think the risk to the system will emanate from outside the U.S. whether it's in the emerging markets in a more profound way or in Europe and Japan. And those things make me a bit nervous because, the central banks can execute these policies as long as inflation is contained. And all of a sudden, if you create higher levels of inflation, and while you're not growing fast enough, that puts them in a really bad spot. And like I said, I don't think that's going to happen, but that, longer term, I could see that playing out, and that is a concerning dynamic.
Okay, great. Let's turn to some questions that we have here. First, a question about China. Do you see? So you mentioned some of the risks with China, but do you see investment opportunities within China today?
So I got in trouble on that today. So we do, and I think somebody asked Jay Powell today about said BlackRock buys Chinese assets in the. I know why that. But yeah, I mean, quite frankly, I think some of the most sort of successful and I think incredible technologies in the world sit in China. I mean, there are equities, certainly the Alibabas, the Tencents, companies around China, some of the semi companies like a Taiwan Semiconductor, although obviously not directly China. There are, we were very invested in the Chinese rates market, but we've reduced some of that all because of worry of geopolitical tensions, all because it's rallied so much relative to the rest of EM, if it's EM. But yeah, I think some of the best opportunities in credit in China are in some of the best opportunities in the world. Certainly when I look at credit in Asia, China has the best opportunities to look at in some of the property companies and some of the industrial businesses. So I think there's great opportunity. I think China is one of the most exciting places to be an investor in. Like I say, you got to be a little careful today. It's become politically charged. And so, we're trying to be sensitive about how we think through that. And there's some real challenges there. But I think people underestimate the technology development in China is extraordinary. And it is literally the paradox of why Europe cannot grow, is they have not spent on CapEx and R&D to develop it, whereas China has. And so I think it's one of the most exciting places. So you got to be careful about all the stuff around it. But yeah, no, I think there's great opportunity there.
Do you worry about the demographics, or do you think there's still enough a wave of movement into cities that kind of offsets the generally poor demographics that they see as a population overall?
I've been trying to think about, it's one of the broader questions about urbanization from what just happened. And we've been, certainly on the domestic side, we've been thinking about urbanization and how does urbanization change? What does it mean for real estate, commercial and resi? But in China, it's the same. We still have more work to do to think through how does that evolve for China. But the medium to longer term demographic is not great in China. It's not like Japan, but it's not great for a variety of different reasons, including the one-child policy, et cetera. So yeah, that is one of the challenges. Part of why I outline it as a risk in that the debt's so big, and the demographics are. They're not bad, but they do have that weird bubble. That makes it a bit more challenged. So, but they have, the ability to control the economy, the banking system, and they think generationally and they think longer term, and their policies. I'd say when I've traveled the world, used to, and every time I meet with policymakers in China, they're pretty brilliant. I quite frankly think they're some of the most brilliant policymakers in the world, and they tend to think of things over longer periods of time, certainly versus the way we do when people are elected for 2 to 4 years and care about their elected being reelected. But so anyway, I'm confident. They've been people who've been shooting at China and their ability to do it, and I watched the way they pull on different levers, and they're pretty darn successful at it.
That's great, and that talking about the fact they don't have to worry about elections segues us into what I think will make the last audience question here. Always fun to get a somewhat politically oriented question. I'll let you dance through this one. What are your thoughts on the upcoming U.S. election?
How do I answer that one? Yeah. So listen, I think it's going to be. I have a lot of conversations with policymakers, and I think they're going to pivot off of a lot of these ideas I think China's going to be right front and center. And listen, I think the president has a real challenge. I mean, I thought a couple of months ago that it would be almost impossible to unseat the president given how the economy was moving.
Yep.
But boy, you do have the likelihood of that happening and the likelihood of having a full democratic shift in Congress has accelerated markedly. And I do think there is a likelihood of that happening. And which there are a couple of things from an investment point of view. I have some markets will react negatively at first blush. There's also some things around infrastructure that could happen, and et cetera. But you could have a significant shift in politics going into year end. One thing I find about markets, and I've said this a bunch on our calls, is the markets can only do one thing at a time. It's like last week, I just want to talk about China trade. That's all I can focus on. It's just the trade tension. That's it. And this week, I just want to talk about Moderna. I want to talk about the vaccine. And then it's like the election thing that's out there. We're going to deal with that. But sometime in October, we'll deal with that. It's a funny way the markets do this for 33 years. It's just so funny. Can do one thing at a time. Oil, that's all we're going to deal with today. But the election is going to be a big deal, and politics getting into September, October are going to have a big influence on these markets for sure.
Yeah, it's going to be, and this isn't a view one way or the other, it's a general view about both sides. It's going to be fascinating to see an election process play out where it seems like both candidates do better when they get out of the way and get out of the limelight. How you manage an election through that is going to be pretty fascinating.
Totally.
So
I agree.
Let's turn to, I think, what has become everyone's favorite part of these sessions, the lightning round, and have a little fun to wrap up here, Rick. First, what is the thing you miss the most while in lockdown?
So we were right before we came out. We talked about I'm playing golf. I mean, this markets make my head spin, and all I look for is like on the weekends, can I go play golf? And they shut down the courses, so that's reopening. And between that and going out to restaurants, this may take a bit of time. I don't miss travel, I have to say. That is definitely not. I'm kind of getting used to not traveling, but I think playing golf and going to restaurants is sort of my outlet. And that's been the hardest one. Thankfully, they're opening the courses up iteratively.
That's great. Well, I think you might have answered the pleasant surprise about not traveling, but we'll see if you have anything different to say. What's been a pleasant surprise while stuck at home?
I never thought this would happen. My daughters are 26 and 24 years old, and they're sort of moving on. They got close boyfriends, but we've been having dinner every night together, and on the weekends we're having breakfast together. It's it's kind of a neat thing that we'll look back. I think we'll look back on 20 years from now and say, remember that time that we got to play games at night and we watch movies together at night. And when I was you thought that was gone. In fact, even 15 years ago, because you're traveling so much, you never had like 3 nights in a row. This is 7 nights in a row every week. So that's been a very cool thing, getting to know your family a little bit better.
That's great. That is great to hear. How about a show, movie, or book that you've enjoyed the most during this stretch and would recommend to everyone?
So I feel illiterate because I've been so swamped with work and research and everything. I haven't read any good books. And but I've been watching. I've been watching this Michael Jordan Last Dance. That's been unbelievable. I think that's been sort of taking you back in time. That's been incredible. And I have this strange addiction to the show Shark Tank. And I think it's because I've grown up in credit and loving business, and I find it fascinating and funny. And so I've been watching I mean, literally, because there's no new, you certainly can't watch sports on TV. And I'm tired of watching CNN. I literally can't watch another show of CNN and the virus count. I can't watch it anymore. So I've been getting in there. I've been become addicted to Shark Tank. I can't believe how many episodes they have. I just keep watching, and it's like I haven't seen a repeat other than a couple of times. But
somehow,
I like
somehow with production shut down, they're not running out of episodes. It's amazing.
No, I don't know how it could be. I don't know how many they've made, but anyway, I like that show.
Going back to The Last Dance, do you have a favorite part or a part that was most surprising to you, having already lived through it in the 90s?
So I didn't know the whole thing. I didn't know the whole Scottie Pippen not playing and having because of his contract and staying out for a longer period of time and hurting the team. I guess I knew it. I guess I forgot about it.
Yeah.
But I thought that was fascinating. I thought some of that stuff, the drugs that went on, I thought that was, I didn't realize how acute that was. I thought that was pretty wild. And then just watching how he controlled a game was just the most, and for his, he's not a 7-foot player. I thought his ability to control a game and his intensity and a kind of competitive spirit, just amazing. I mean, unbelievable. The whole thing I thought was just a whole human story in so many different ways that I thought was incredible to watch.
It's been great to have that on, giving us some new content. How about I'll give you another lightning round question here as a related follow-up. Do you think the NBA comes back this summer?
They say they are. I mean, I think they're. I watch hockey. I think I watch more hockey than basketball. But I think they're going to try and do this. It's going to be very weird with the no fans in certain locations, and it's very weird. I'd almost, because I'm a purist about sports, I'd almost feel like that when I know there's money involved, et cetera, but it's just going to be very weird. And it's always going to have an asterisk next to it, but I don't know. I think they're going to try. I think the NHL is going to try, and I think what baseball is going to try, and it's all going to be very weird.
Yeah, I think we'll all take it just to have something to watch, though, right?
No, that's true. I watched the golf this weekend. It was a kind of a goofy thing, but it's nice to actually have something that's not a repeat. I'm tired of watching golf tournaments from 10 years ago.
Exactly. How about the thing that people are not talking or worried about enough?
I said definitely the selling ball thing is something that nobody really talks about. That is a big deal. The other one, which you referred to, is this virus mutating in different ways. And, this is one of those things that, human nature is, it's very, we'll err on the side of conservative and cautious given what just happened. And it won't take much for some strain of this or some way the virus mutates that could be really, really devastating. And people are not going to take the risk. And that definitely worries me about how that plays out, because people tend to look at the exceptional situations. I remember I talked too much on TV about Tesla and companies like that. And, it's interesting. Like they build the Tesla. There's always this chance to get it from 300 miles on a charge to 350, when less than 1% of the people ever will use that. But people buy a car based on it, and because it's got 350 versus 300, despite the fact that 99.something% of the time you never take it that far. But it's the same thing with something like this. If you have one or a few instances, then the people will focus on it, and that does make me nervous. Married to the some of the things, the inflation things, some of those others, but those are things that make me nervous. If I can throw one other thing, these markets have come back from a liquidity point of view. They still are still incredibly tenuous, and you just got to, I think the way we look at managing our risk, and we do manage our risk, is just make sure, you talk about diversification, make sure you're not putting too many eggs in one place, and because any exogenous shock in some of these markets, they're very good about taking size exposure, big risks when everybody's in together. You look at some of these new issues that come to market, and it's like 25 times oversubscribed. It's because we're all in together and we're all holding hands and everything's good. And then, if there's uncertainty, then it just stops. And I just got to be so careful about that today.
Yeah, definitely. Last one here. Do you have a prediction on a way our world will be permanently changed?
I mean, I think artificial intelligence just moved to I thought it was coming on faster than people thought. Now I think it's going to keep going, and I think a lot of businesses, whether it's how do you run more efficiently, how can you people-wise, et cetera. I think artificial intelligence can be bigger. I think virtual, no wisdom to this, but I think more things virtual. And I think from a company point of view, I think companies are going to run higher levels of cash than they had for, and you saw this like after 2002. Remember the whole commercial paper thing, and companies were using loads of commercial paper, and then they say, you know what, we're just going to run higher levels of cash. I think you'll see I think you see the savings rate in this country that'll go up and stay sticky high. And I think companies will run with larger levels of cash because, you know, you look at what happens, you draw on your revolvers, CP market is hard, and I think it'll be a permanence to, gosh, we're just going to run a higher cash position. And I think you know, the impact of that is he obviously drags on ROE, but I think companies will take that versus jeopardizing the longevity of the firm.
And so you mentioned the savings rate going up. Do you think that cascades down to the individuals? Are we all going to be children of the Great Depression in some way, where we're a little bit more conservative or a little bit more budget conscious than we've been as a society?
I totally think that, and you know, I think the greatest example of this is when you go to negative interest rates. Negative interest rates means the savings rate goes higher. You look at all these countries that implement. So theory is you bring rates low enough that it forces money into investment. But then when you get too low, i.e. zero for a long time or negative, the savings rate goes up. And people are worried about their income, and so they raise their level of savings. And I absolutely think that will be the case here, is that people will think about, gosh, I got to save more, let alone you could have a crisis like this in the future. But I definitely think that's right.
Maybe bad for growth in the near term, but probably good for our overall financial health over the long term. So hopefully we can balance those two sides of things. Yeah. Well, Rick, this has been awesome. Really, as always, enjoyed chatting with you and appreciate you taking the time to share these views with our clients. And as we said, we'll be off next week, and we'll be back with George Walker on June 2nd. So, Rick, thanks so much for joining us today.
Thanks, Jim. Yeah, thank you all for listening. Appreciate it.
Take care.
Bye.